So it's been a while since we've been with you all. It's been a couple of weeks, and we just wanted to give a full market update and really get back to and start talking about this again. So Quint, what's going on in the world?
Wow. Well, Logan, I can admittedly say this is one of the most difficult environments I've seen in a very, very long time. I was talking to someone just the other day, and they were asking, what's going on? What do you think about all this? And I said, well, the difficulty in this environment is you have equity markets clearly under pressure. I mean, you'd have to be living under a rock not to see the headlines of the volatility, which, as you know, is code for declining prices, right? Wall Street gibberish for declines. But the market's off considerably. I think the S&P's off 14 or more for the year now. The NASDAQ is well over 20% for the year, 21, 22, something like that. Plethora of stocks are off, 60, 70%. So the equity market's down. Now, normally in a balanced portfolio, you have bonds that are there to cushion the blow, right, to soften the blow. Well, the result of the higher interest rates, bonds and interest rates move like a teeter-totter. So as interest rates have been going up as fast as they have, which is, my understanding, the fastest incline. So the speed at which interest rates have risen faster than ever before, I guess, in history. I don't know how they measure that. I guess just time, duration, et cetera. But that has taken bonds down. So the 20-year bond, for instance, the 20-year Treasury bond is down 20% year to date. So if you own a Treasury bond that's longer than 1 or 2 years, which most people do in a bond fund or something, that's down considerably. So the only thing that has sort of, quote, weathered the storm is really cash. However, cash is purchasing power, and that's down 9 or 10%, depending on, the prices that you're paying for whatever. So there's literally nothing that has been a safe haven. I mean, gold has been a safe haven. Energy, some commodities, which, is a direct result of what's going on. But it's been very, very difficult. The saving grace, I would say, and as you know, and our audience knows, I try to be as agnostic to what's happening out there as possible. And I try to be as open-minded to maybe things are bad, maybe, whatever, is the economy is still relatively good. The job market is very hot. Consumer is healthy. Now, the stock market is telling us, or at least it's trying to tell us, that all that's about to change.
Right.
Now, the irony of this whole thing is that that's happening because of the Federal Reserve.
Yeah.
Because the Federal Reserve is sort of putting a stake in the ground and saying, we are going to do everything at our power to fight inflation. Well, Jerome Powell, Jay as Jerome, right?
Yeah.
Jay Powell. I was like, wait a second, is his name Jay or Jerome? Anyways, Jerome Powell came out and said in his press conference, we have the ability to control demand. We can control demand. Now, what he's saying is we can make the economy slow down so that people don't spend money. Well, how does that happen? That happens through job loss, market declines, and sort of recessionary activity. So what he's saying publicly is, in order to beat inflation, in order for you to pay less, money for groceries, we're going to eliminate jobs, or
Right.
we're going to slow down businesses such that they have to lay off people.
And I think that was kind of in a response to answering the question of, can you do anything about the supply side, which we know is kind of
Right.
the issue, and that's causing the inflation is the supply side of the market. And his response is, well, we only have the tools to affect the demand side.
Right. I've joked in letters, we're trying to work with an ankle. We're trying to heal an ankle injury by doing shoulder surgery, right? It's not, in my opinion, you can raise the rates all you want. It's not going to change the oil prices. It's not going to change the gas, food prices right now. It's not going to change the shortage of inventory on the shelves because we can't get it out of the ports, et cetera. So by raising and the market's saying that as well.
Right.
And that's why the stock market is saying, if you keep raising all these rates, you're not going to have to worry about inflation because there's not going to be anybody to go out and buy things, right? Nobody's going to have any money. Nobody's going to have any jobs. Now, again, the difficulty from my vantage point, why am I saying to people, hey, stay the course? And, why aren't we raising more cash? And why for younger people am I saying, oh my goodness, this is an opportunity for you to be a buyer? Why are we looking to put our cash to work for clients, right? Why are we doing that? Because unlike the past where we've had economic concerns followed by, or the market signaling the economy, right? If you think about the market started to decline in 07 and 08, telling us we knew this already, that there was a mortgage, that there was an inflated housing and mortgage issue. Now, why is that different today? Because we don't have people buying 4 homes, 3 on spec, right? We have people paying higher prices for homes and having to finance that, but we don't have them building spec houses to flip them, to the neighbor, to the whatever. We don't have that.
Yeah.
We just have inflated prices. Back in 2000, we had massive rampant speculation in all the .coms that came out, and we had people, piling money into those stocks. And as we declined, the bubble bursted in 2000, we didn't have pessimism, ironically. Every time the market declined in 2000, people wanted to buy that. So what do we have today? We have a relatively good economy. We have a relatively low unemployment rate. We have a supply chain that is slowly trying to, improve. We have businesses that are coming out of COVID. We have a consumer that is strong and pent up. And so we have the elements for a strong economy and therefore a strong market, but we have a Fed saying, no, we can't let this happen. We got to slow this down. That's why I keep looking and saying, okay, if we get any semblance of lower inflationary pressure at all, CPI or anything, even more negative economic news, ironically, that will make the Fed say, okay, we're going to continue to watch the data and we're going to continue to do this at a moderate pace.
And make adjustments. If the Fed sees maybe the CPI coming down over time, they may be inclined to make adjustments. And I know CPI data comes out next week.
Right.
So
it's going to be important to watch.
Yeah.
It'll still probably be hot, but it'll be, question is how hot, right? How hot will it be? So, look, here's the deal. It is a difficult environment. I never in my wildest dreams, when we did the standard deviation video, I know we've talked about that ad nauseum. If you've not seen that, go on and watch that. But I never in my wildest dreams thought we would be dealing with extreme moves on standard deviation. The combination of a balanced portfolio, bonds and stocks, are having almost a 3 standard deviation move right now. So statistics geeks out there like myself, you will know how rare that is, right? That is very rare to have that happen. Now, why did we do that video? Because when that occurs, as it will on occasion, I didn't anticipate it happening 6 months later, but when it occurs, instead of going, oh my goodness, this is all going to end, look at it as, okay, this is a rare occurrence. That means we're going to shift back to the average. And we will at some point. We don't know when. We don't know how long it will take. I think the bottom line is there's a lot of things in play. There's a lot of elements in play here. And what I'm sharing with people is we kind of segment people into groups. And this is, look, thousands of people are going to watch this, right? So many of you are not clients. If you're a client of ours, I feel confident that you're in the appropriate allocation. We know where you are, time horizon. We hopefully have a full-blown plan in place, et cetera. So we're dealing with the anomalies in the market, but we're dealing with them well. But if you're not a client and you're listening to this out there, again, compartmentalize in a couple of different buckets, if you will. If you're young and you're investing, you're dollar cost averaging in your 401k, I wouldn't change a thing. In fact, as hard as it is, and these other 2 groups of people certainly don't like you, but you should be enjoying the market decline. Now, with respect to hopefully not losing your job, right, so it doesn't continue, because if not, we will deal with unemployment issues and it will be a problem. But ultimately, if you have a healthy job and you're contributing and your debt to equity, your personal debt, is minimal, it's a buyer's market. You have to continue to be putting money in and allocating. Your time horizon is long. This too shall pass. You're getting an opportunity that we haven't seen in a long time. If you're in that middle group, I would say, anywhere 10 years or less until retirement, it's very important, again, to be looking at your allocation. You're opening your 401k and you're seeing something you haven't seen in a long time, not just declines, because I know we've gone through that. You're seeing your bonds go down. You're seeing the fixed income portion of your portfolio go down. And it would be very easy to go, oh, let's just get out of everything. Let's just cash out. That could be very detrimental to the long-term plan aspect. So again, if you're well allocated, if you have a bond stock exposure that's appropriate, then maybe look to rebalance. Maybe look and say, okay, where is it out of 60-40 whack? Is it, has it declined to where it's now 50-50 and maybe doing a rebalance, taking some out of the fixed income, going some into the equity, etc. So there's an opportunity for that. If you are in retirement and you're going through a distribution stage, the one thing I can share with you, and this is hard, I understand this is very difficult to keep this in perspective, but your time horizon is life expectancy. Your time horizon isn't next month. It isn't next year. So if you're looking at even a very modestly allocated portfolio, modest stock, lots of bonds, it's down. It's down. Everything is down. So you're looking at that going, oh, I'm in retirement. I'm not supposed to be seeing a decline in portfolios. It's happening. Yep. It will happen. But your time horizon is not next week. It is not next year. It is long way out. Now, what I will tell you, though, is this is a good opportunity if you don't have an advisor. And I'm not making a selfish plug. I'm literally saying you can find one. People are all over the country. This is a time to chat with somebody and to say, is my allocation appropriate? We're going through this decline. I'm seeing a decline. We have people coming in and saying, is this, I had somebody just the other day, brought in a portfolio and said, is this acceptable? What I'm down right now. He was a 60-40 allocation. He was down about 10%. I said, it's acceptable. It's exactly where you should be. And I said, I'd love to have the ability to win this business, but it's a good allocation. If your advisor is good and you're communicating with him, no problem. It's everything is down. Bonds are down, stocks are down. And again, this is an anomaly to see both. It's happened. It's happened before. There's for sure. But it's an anomaly, and it should not last.
Yeah. And I think for those folks out there that are trying to understand, okay, where do I really need to lie in the allocation part? Or maybe even what bucket do I lay in, not just age-based, but whether it's with us or your advisor or whoever you work with, having that full financial plan is so important in this environment, and being able to say, okay, yes, this is happening. Yes, the markets are going down, but am I still okay for retirement or my long-term goals? It's super important.
And it's temperament as well. We talk about this regularly. It's not just what your age is and your allocation and your time horizon. If you are losing sleep, I say this often, if you are allocated as you should be based on a plan, based on math, but yet you are losing sleep, it is impacting your livelihood, maybe you came through COVID. I share this with, and I'll do this again after the fact. So we'll get through this. Yeah. We will get through this. The markets will recover. There will be coming a time where we say, okay, remember how good this feels? Put it on the shelf. And I've written that. I've tried to find it. I need to find it and clip it and send it out. But I've written that in the past during really good times. Bottle this feeling up and put it on a shelf and remember it. But we'll get there. And so what you don't want to do, though, is you don't want to, feel saved, if you will. So let's say you felt this way in COVID and you were bailed out. Basically, the market recovered and you were bailed out and you're like, okay, not going to do that again. Then now here we are. We're not COVID levels, but, it's ugly. It's very ugly out there. So you might be sitting there saying, oh, my goodness, I can't. I'm a wreck. Well, the reality then is you're too risky. It's too aggressive, and you have to dial back. Now, if you dial that back and your financial plan requires you to work longer or requires you to spend less, that might be the result of dialing back. So it's all an equation, and you have to be doing that equation with someone. You really do. I mean, yes, spreadsheets are nice and scratch papers are nice and you calculating it out, but factoring in inflation, different inflation rate for consumer goods as it is for medical, factoring in out-of-pocket, Medicare premiums, factoring in end-of-life costs, factoring in stress tests for the market, all of that has to be inside of a plan, all of it. And it's more important than ever to do that right now, for sure.
Great. All right. Well, we're going to wrap it up. We just want to say, I know it is a difficult time out there. I know it is challenging with the markets and everything that's going on, but we hope you have a great weekend. Enjoy the Derby. All the mothers out there, happy Mother's Day. We should see you next week. Make it a great one.